The S&P 500 is near all-time highs. Every headline says the market is strong. And if you're trading off that number, you're being deceived. 10 stocks are carrying this entire index. By the end of this video, you'll know the breadth data that shows the other 490 stocks are already losing, the one volatility instrument revealing the fear the VIX is hiding, and the two conditions that historically ignite this kind of unwind, and why they're not coming. They're already here. If you don't understand what's underneath this index, you'll keep trading a market that doesn't exist. When those 10 names crack, your account will feel it before you see it. Here's what most traders see right now. The S&P 500 is holding near highs. The index number looks strong, and they read that as the market is healthy, breadth is decent, and there's no reason to be defensive. That reading is wrong, and I want to show you exactly why. The S&P 500 is a market cap weighted index. That means that the biggest companies have the biggest pull on where the number goes. And right now, the top 10 names in this index represent more than 40% of the entire index's market cap. 40% in 10 names. That means the other 490 companies, 98% of the names in this index, control less than 60% of the weight combined. Now look at what's happening underneath that surface. The percentage of stocks in this index trading above their 200-day moving average has been in a long-term downtrend. That's the footprint of a market where the damage is spreading quietly while the headline number holds. And new 52-week highs declining, even as the index stays near the top. That divergence has a name. It's called breadth failure. And it's one of the clearest early warnings that the foundation under an index is weakening. The number CNBC quotes all day, the S&P 500, isn't a picture of 500 companies. It's the picture of 10 companies. The other 490 are already losing. They're just not heavy enough to move the needle on a cap-weighted index, which means if you're holding anything outside the top 10, your account is already showing the damage the index is hiding. So if those 10 names are the whole ballgame, the question isn't whether the market is overvalued. The question is, can those 10 names keep levitating indefinitely? And most traders will tell you, watch the VIX. If it's low, you're fine. Here's why that's exactly the wrong instrument for this environment. The VIX is subdued. That's the first thing most traders check. Low VIX, low fear, risk on, all clear. That's the conventional trade. But here's the problem with that read right now. The VIX measures implied volatility on the S&P 500 index, not on individual stocks, on the index. And in the market where 40% of the weight is concentrated in 10 names, those names can be swinging hard while the index barely budges. That's not a paradox. It's math. When stocks don't move together, the index stays smooth, even if individual names are moving dramatically. Now there's another volatility measure. It's called VIXEQ, the equal weighted implied volatility of the S&P 500. It measures the average implied volatility of individual names, not the index as a whole. Right now, VIXEQ is at a record premium to the VIX. The spread between those two numbers has never been wider. What that tells you, individual stocks are carrying real fear, but the index is absorbing it because the concentration in those 10 megacaps is acting as a mathematical dampener in the index level vol number. The VIX isn't broken. It's doing exactly what it's supposed to do. You're just reading the wrong instrument. The VIX tells you how calm the index is. VIXEQ tells you how scared traders actually are about individual names. And right now, those two readings have never been further apart. The fear gauge most traders are watching is mathematically suppressed by the same concentration that's holding the index up. VIXEQ at a record premium to VIX isn't a technical footnote. It's a real fear signal, and almost no one is looking at it. So the volatility surface is already showing the fracture lines. But there's a second, deeper layer of data that most equity traders never look at. And right now, it's giving off a signal that almost everyone will read completely backwards. Implied correlation. That's the metric almost no one talks about. It measures how much the stocks inside the S&P 500 are moving together. High correlation means stocks move in sync. That's the risk-off environment, a panic. Low correlation means stocks are doing their thing. Most traders read that as a healthy, calm market. Right now, implied correlation is at an extreme low. And if you look at that chart and think, good, the market is calm, that's what I need to walk you through. In a normally diversified index, low correlation is exactly what you want. Stocks moving on their own fundamentals. That's healthy. But we're not in a normally diversified index. We're in an index where 10 names control more than 40% of the weight. Here's what those low implied correlations actually mean in the structure. It means those 10 names haven't started moving together yet. The correlation between the mega caps is still low. The index is smooth. The VIX is quiet. But the moment those 10 names start moving in the same direction, downward, implied correlation spikes instantly. And when the correlation spikes, the diversification benefit of holding a broad index collapses. Every name gets hit at once. The lower implied correlation goes before a reversal, the more violent that reversal tends to be. Every point that implied correlation drops is a sign that the market is calmer. It's a sign the trap is more fully set. Low implied correlation in this environment isn't a green light. It's a compressed spring. The calm you see in the index isn't a signal that everything is fine. It's a signal that the unwind, when it comes, will be fast and hard, because concentration has quietly erased the diversification that would normally cushion a broad index. This would be something to model and watch, except the conditions that have historically ignited this kind of unwind aren't in the future. Two of them are moving right now. Every structural fragility needs a catalyst. You can have a loaded spring, deteriorating breadth, a record VIXEQ premium, and the market can stay propped up for a long time, as long as the conditions that sustain those 10 names keep holding. So the question is, what breaks it? Two things have historically been hostile to large cap growth stocks, the exact names that are carrying this index right now. First, liquidity. When liquidity contracts, when money gets tighter, when credit conditions tighten, the names that benefited the most from abundant, cheap money get hit hardest. That's the mega cap growth companies that make up the bulk of the top 10. Second, the dollar. A rising dollar is a direct headwind for multinational revenue. Most of those 10 names make a big chunk of their money outside of the United States. When the dollar rises, those foreign earnings are worth less in dollar terms. Margins compress. Guidance gets cut. The dollar is already rising. These aren't projections. They're not things I'm telling you to watch for. They're current conditions. Here's where we are. The market you see every day, the S&P near highs, isn't the market you're actually exposed to. It's a weighted average of 10 companies sitting on top of a deteriorating foundation. And the calm holding it together, volatility and correlation data already prove it's artificial. The fear is real. VIXEQ shows it. The trap is set. Implied correlation confirms it. And the ignition conditions, declining liquidity, a rising dollar, aren't coming. They're already here. This isn't a prediction. The structure is loaded. The triggers are live. The only missing variable is timing. And when those 10 finally move, they all move together. There's nothing underneath to slow it down. You came in asking what it means when 10 stocks carry the whole market. Now you know the answer. And you know exactly what the data looks like just before it stops working. You now know what's underneath the index, the concentration, the hidden fear in single stock volatility, and the two conditions that are already moving towards an unwind. But knowing the structure is fragile isn't the same as knowing what price is actually doing right now. That gap between a bearish thesis and a confirmed trade is exactly where conviction becomes dangerous. Here's what understanding that story also doesn't give you: the truth about price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for knowing the direction of price. It tells you whether this narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be right about everything that you just heard and still be on the wrong side of a trade for days, weeks, or even months. That framework is what I teach. The traders in my community don't get trapped by bearish narratives. They know where a trend fails, and until it does, until price confirms it, they will trade a bullish trend until it fails, even if it is against a bearish narrative. They have a framework for reading it themselves. That's the process I teach every day at eminiaddict.com.